Good morning, distinguished guests, ladies and gentlemen. Welcome to today's panel discussion on driving private capital mobilization through innovation in infrastructure financing. My name is Gregory Liu. I'm the Director General of Financial Institution and Funds Department. It's a global department of AIIB, which is newly set up. As many of you might know, the infrastructure financing gap in emerging market remains the most pressing global challenge. Traditional sources like government funds, development financing are no longer sufficient. To meet the scale and urgency of infrastructure needs, especially to do the scaling up of a climate resilient and sustainable infrastructure, we must unlock significantly from the private sector. At AIIB, we are committed to catalyzing this shift. Today, we have the honor to invite a very wide spectrum of the panel because we feel innovation cannot be done in isolation. It requires collaboration across governments, sovereign wealth fund, private equity, lenders, insurers, and the multilateral institutions. So that's the spirit of today's fully inclusive panel discussion. Certainly, we will also give floor to you to have the questions and answer session with them. Now it's my honor to join this truly distinguished panel. I would like to introduce them briefly before we dive into the conversation today. It's my pleasure to introduce Ambassador Tatiana Rosito, Alternative Governor on the AIIB Board of Governors and Vice Minister of International Affairs at the Ministry of Finance, Brazil. Ambassador Rosito is a distinguished economist and a senior diplomat with over 25 years of experience across the public sector and international organizations. She has spent over a decade working in Asia, so I think she's a role model of connectivity between non-Asian members and Asian members. She has performed senior role like in New Development Bank in Shanghai and Petronas in China before she takes her current role. And next to her is Mr. Mounir of Rakiza. He's the CEO and the founder of the Rakiza Fund. Mr. Mounir brings over 20 years of international experience in private equity, infrastructure, and corporate finance, with a deep focus on the MENA region. To my knowledge, he also worked briefly in Asia, so it's another role model to know different parts of the world. He now manages over 1 billion funds called Rakiza Fund 1, focusing on Oman and Saudi, so I'm sure we will hear his insight of such investment. Continuing with our distinguished panel, I'm delighted to introduce Princess Raziz Al Saud. She's the head of financial institutions and investor relations at the Public Investment Fund of Saudi Arabia. Princess Raziz is a highly accomplished leader with extensive experience in financial sector and currently serves on the boards of major national institutions, including the Saudi Railway Company and Ministry of Investment. She previously held the role of Assistant Deputy Minister of Finance for bilateral international affairs, becoming the first woman to assume an executive position at Saudi Arabia's Ministry of Finance. So you can see she surely will bring lots of insight for us when Saudi is embracing the infrastructure investment. Our next distinguished panelist is Mr. Fabrizio Massa, Managing Director and Global Public Agency Leader for Credit Specialities at Marsh, based in London. It's a very mouthful title, but I understand he actually bridged the gap between public sector, like multinational like us. He has done more than a decade in Marsh in this regard. We hope that he can share the insight on how to bridging this gap between public sector, lenders, and all the way to the institutional investors. And last but not least, we have Mr. Nicholas Tan, CEO and Executive Director of Bayfront Infrastructure Management in Singapore. And he's also the group head of markets and investor service at Clifford Capital, the parent company. Mr. Tan oversees all the bank and institutional investor relationship across the Clifford Capital Group. And it's specifically worth mentioning his pivotal role in the inaugural issuance of the infrastructure ABS in Asia market. It's called Bayfront Investment Corp 1. And he's still overseeing the issuance, while AIIB also is I have to give a full disclosure, AIIB is also an equity investor in Bayfront in 2020. So with that, we have an exceptionally experienced and diverse panel with us today. To help to make this conversation a little bit of a structure, we try to follow three themes today, touching on fundraising and the financing, development and of capital, and evolution of the investor universe. Through these themes, we will explore how private capital mobilization in infrastructure is evolving and the opportunities and the challenges shaping the market today. Yeah. So now let's dive into our first theme, the fundraising and the financing. Before I move back to the seat, I will probably poke Mr. Munir with the first question. You know, Rakiza has a very focused area of investment, infrastructure in Oman and Saudi Arabia. What factors have made these projects attractive to investors? What approach has Rakiza taken with respect to fundraising across the region and beyond? Perhaps you can share with us your experience after you come to this region to raise funds a few years ago. Yeah.
Thank you, Gregory. And it's an honor for me to be here today, actually, and definitely being part of AIIB investments is also something that we're really proud of. So Rakiza's story is quite different because we started in a region where I was always challenged at the beginning that the cost of capital is low. How can equity returns can be attractive for investors? And the reality has changed, and definitely we had demonstrated to our investors that there are opportunities in the region. These opportunities are definitely worth exploring. Since 2015, when oil prices actually were at the low level, we've seen a move and a wave of privatization coming to the region. Especially, I'm talking here about the GCC region, where we mainly focus on. And that privatization move, for us, we saw an opportunity as to be the first mover into that move. We've seen governments reviewing their public-private partnerships regulatory frameworks. We've seen also opportunities coming into the market where financial investors, sophisticated financial investors will be required. So we decided to step into as a first mover into these opportunities, create the right platform, bring the best practices internationally in terms of making sure that we have the right governance, the right structures for financial institutions to see the value from this investment. And we started building a very diversified portfolio. Today we own 5 assets. These assets are very critical assets for Oman and KSA. So we own a port in the north of Oman called Sohar Port. It's a gateway container terminal that basically serves the economy in Oman in the north. And we also own a stake in the largest telecom tower independent company. That's a story maybe I can share later how we did that project. And we also own a 40% stake in Oman Broadband, which is basically a provider of fiber to home in the country with a monopoly kind of characteristics as a business. And we also own a power plant in Saudi, in the eastern province of Saudi. And we also own another PPP project in Muscat. So collectively, we have 5 assets, and these assets are very diversified in terms of nature. What makes us also different, definitely, as I stated, we were first movers. We speak the language of the local market. We understand the local issues. We work closely with the government agencies, with the private sector, with the debt market in terms of banks and the rest. So we understand how we structure these projects. We were able to do many bilateral projects, basically based on our understanding of the market and our being able to basically be the first mover. So we had a very, I would say, unique value proposition that allowed us to raise $1 billion as Fund 1, which is we're really proud of. And definitely it triggered also many other global fund managers to come to the region. And we certainly look forward to continue our story and be able to do a second fund in the near future.
Thank you, Munir. I actually feel quite dearly when I heard those projects you highlighted, because personally, I think private sector should not be seen as just a totally opponent side to the public sector. The two sides should work very closely for the common interest. In fact, some project he mentioned, AIIB was a lender before Rakisa acquired a share, like Oman Broadband. At that time, I know we struggled to get any insurance cover for a 3-year-old company which doesn't have the track record, and
indeed.
Which is going to roll fiber. Yeah.
Indeed, I think definitely the AIIB played a big role there in unlocking the value of broadband, replacing the technology of copper to connect to homes and using fiber as basically as the latest technology. It helped a lot in making the success of this business, In less than 10 years, the company penetrated the full capital of Muscat and also penetrated, I would say, 50% of Oman. So it's a very successful story. MDB role played big role, basically add value to the story of Oman Broadband. And when we decided to buy the company, we saw the value of the business, and we understood that AIIB took that risk at the beginning, but ultimately added great value to the country.
Thank you. Thank you. In that spirit of the collaboration between private sector and public sector, now I would turn to Ambassador Rosito, who represents the government side. We all know Brazil has a very big scheme, and the country has made substantial progress in attracting private capital into infrastructure. So from your perspective, what policy changes or regulatory shift have made the biggest difference in encouraging long-term investment? Ambassador.
Hello. Is it on? Yes? Yes. So first, good morning to all, and also to fellow panelists. And Gregory, thank you very much for inviting us to this panel. Actually, we have, it's interesting that from the government side, I'm here actually with other 4 panelists from the investment side and private mostly. But, and this partnership is crucial, right? We cannot go along, we know that. I would take, I think before thinking of infrastructure and the importance, and Brazil has indeed received, is amongst the highest recipients of investments and FDI for many years, including in infrastructure. I want to highlight that before regulatory shifts, actually, what is important is really regulatory stability and you know, the trust in the overall environment, macroeconomic and enabling environment. And overall, we have been able to attract a very stable flows of capital and investment, especially, you know, since in the 90s, if you think of the broad spectrum of infrastructure, you know, all the way from, you know, telecommunications, energy, sanitation, transportation. So right now, Brazil, from the investments in infrastructure, which are about 2% of GDP, roughly 78% are already from the private sector. But they are more concentrated in areas like, you know, telecommunications and energy. You have very high regulatory, you know, security and stability there. But it's more difficult to have more involvement in areas, although we do have, through different instruments of concessions, public concessions and authorizations, in areas like sanitation that have been open for the private sector. And we do have, I think, AIIB involved in some sanitation projects there through the new sanitation framework, but also in roads and railways and transportation overall. So this we still need. We can double investments in we would aim for doubling investments in Brazil in infrastructure to 4% of GDP. And a lot of that will be, you know, with improvements using new instruments. For example, we have established these incentivized bonds, we call like the debentures, like the incentivized bonds where you have exemption or reduction of income taxes for investments in infrastructure, all the way to personal income taxes. They have been quite successful. Funds could also enjoy that, funds that are established for that purpose. I want to add one or two more elements that are crucial and where we have been working, especially in the last 2 years. One, because one of the major complaints of investors is foreign exchange risk, especially for the long-term projects, right? So we have developed a mechanism of foreign exchange risk mitigation. This has been developed together with another fellow, MDB, in Latin America, but and it aims at first encouraging blended finance, but also with specific lines for foreign exchange risk mitigation that will be launched soon. The blended finance line has already been, you know, very successful in 2 bids. What we do is we make a market-friendly mechanism where financial institutions would bid for treasury money. So we set, you know, a target, and finance institutions, they should plan for specific projects that are aligned with especially our ecological transformation plan. So we are talking about of investments, including in many infrastructure areas, especially, for example, in clean energy. There are other areas related to, you know, bioeconomy, the nature-based solutions, but a lot of energy there too. So this is one important mechanism. We have also established a country platform where we want to bring together different actors to leverage more private capital for the riskier investments, especially when we think of new technologies. So we have these 2 major hurdles, like the new emerging technologies where even beyond the high cost of capital or the higher cost of capital that we face in MDEs, there is also the innovation factor, right? So we have established this platform to work. It is in BNDES, our National Development Bank, with oversee from the Ministry of Finance and 3 other sectorial ministries in infrastructure like mining and energy, for example. We aim to bring together global financiers, including MDBs. The AIIB has been taking part in meetings there, and climate funds that could also help de-risk, bring some catalytic capital. and leveraging private sector. We are also bringing insurers to that. So I think really putting in place the right mechanisms for leveraging private capital is very much in our focus.
Thank you, Ambassador. You made very good introduction of how diverse the investor base you have touched on. In fact, if I may share some personal observation, when our team go to Brazil to explore project, they actually came back to share lots of learning, touching on the access to the bonds market, etc. Because AIIB is a project-focused bank. We also want to know, before stepping in, there should be a step out so that the institutional investor can also contribute their portion when the assets reach the operation stage. Yeah. So on that note, I will move to another very large economy. Princess Rasis, how does a PIF engage with a global financial institution and multilateral banks? And what innovations in financial structuring or partnership model are utilized when you represent PIF to talk to investors? Thank you.
Thank you so much, Gregory. And I would like actually to use this opportunity first to congratulate you and AIIB on the 10th anniversary, and also to thank you for mobilizing that very, very important discussion with my distinguished panelists here. Back to your question, as the Sovereign Wealth Fund of the Kingdom of Saudi Arabia, PIF plays a vital role in enabling economic transformation for the Saudi economy, while also becoming a more of an active international investor. When we say international, it's obviously beyond PIF in the region. And one example is obviously the PIF investment in Rakiza, but also internationally, ex-MENA, we're becoming more of an active investor globally and creating a lot of opportunities globally, obviously. Our mission goes beyond the deployment of capital. We're actually mandated to unlock strategic sectors in the Saudi economy and also invest into those sectors globally, to invest in technology and bring back know-how and knowledge to the kingdom, and also, I would say, expand our asset base. We're talking about a fund that was $150 billion in asset under management back in 2015. 10 years forward, it's a fund with over $920 billion as we speak now. The growth of our AUM, obviously, is supported by different funding solutions. If you look at the credit profile of the PIF, it's very strong. It's one of the most actually promising, I would say, credit profiles globally. We have obviously the asset base and the cash to support our investments solely. However, we chose to do it in partnership. And we chose to do it in partnership with like-minded financial institutions, locally, regionally, and internationally, not only to unlock capital, but also to unlock intellectual capital, because we believe we play a very important role in terms of creating innovative financing solutions that also matches the innovations that we're investing in. If you look at the type of projects that we're developing new cities from scratch. NEOM is a futuristic city that also requires innovative financing solutions as well. If you look at just a few years back, the 5 years ago, we've been operating under 4 key objectives, one of which is to create partnerships. And under that, we were able to unlock opportunities with many partners from the financial world. I see in front of me our partners from ICBC, and this is one of the actually banks that we've collaborated with, in addition to many export credit agencies, asset managers like BlackRock, Blackstone, and others as well, and also policy institutions. We've partnered with the likes of HKMA to also create innovative financing solutions, basically to unlock opportunities as well. In terms of innovation, I would say that PIF was leading the way in terms of coming up with innovative funding solutions. We were the first sovereign wealth fund globally to issue a green bond back in 2022. And actually, this was our inaugural bond issuance, and it was in a green format. In 2023, for example, we've also concluded an ECA-backed financing with Keysure. And for us, this serves not only the bilateral relationship or unlocking funding, but it serves a wider, I would say, group of partners as well. It enables, for example, the Korean suppliers to tap into the Saudi market. It enables bank to unlock additional capital basically from our side, and to enable us to obviously diversify our sources of funding. So again, diversification, partnering with like-minded, I would say, financial institution is a key, I would say, goal for the PIF.
Thank you, Princess Raziz. I think you touched very good on the points that collaboration, like-minded, because it's not just the liquidity people bring. There's knowledge and expertise. And I'm so glad through this annual meeting, we also have an opportunity to do the introduction of some of our clients from Asia to PIF and Rakiza. So this is what we keep doing. We like more like-minded partners. Now, in that spirit, like-minded partner, if I may turn to Fabrizio. Insurance sector actually is a quite mysterious sector. But the insurance sector has a stepping up to provide long-term risk solution to facilitate infrastructure financing. Well, what's driving this growing interest, and how does it benefit the financier and the investor? So perhaps you can help us demystify a bit on the role insurance sector play.
Thank you, DG Gregory, and thanks for the esteemed panelists and the audience. Yesterday I made a joke that insurance brokers were not doing a good enough job of publicizing what we do in this sector, and obviously it was a joke because being able here to sit at this panel and to share our experiences with this is quite extraordinary. It's an incredible progress from when I started doing this job. So let's take a little bit of a step back. And so Martian is an intermediary. Okay, so we're a financial service company. We do a lot of type of insurance, but I focus on credit and political risk. We are essentially creating a connection between the demand, typically from financial institutions, public sector clients, investors, commodity traders, corporates, and the offer, the supply from insurance companies. And insurance companies are a very deep, liquid, and non-systemic source of unfunded risk capital that sits within the very large balance sheets of some of the most highly rated insurers globally. It is anti-systemic because the percentage of the credit risk that these institutions hold on their books is minuscule compared to the other asset classes that they insure. So you'll be familiar with weather insurance, for example, and the hundreds of billions of dollars of losses every year that the insurance market withstands. So credit is relatively small parts of that. And as a result, it's anti-systemic because a financial crisis would likely not impact those institutions. These also bring some benefits from a regulatory point of view under Solvency II. And that's the reasons why insurers really like the credit space, because it's anti-cyclical and there's a sort of regulatory arbitrage. How did this market was born? I mean, this started probably in the 80s, but the big bang really happened in the mid-2000s when the regulation under Basel II allow credit insurance to be used as an eligible credit risk mitigant under the regs. What does that mean? That commercial banks have started to use the products to reduce their capital costs against lending. And just shortly after the great financial crisis hit, and the interbank market froze. Yet the insurance market proved very resilient and open for business. As a result, commercial banks started to use the market more and more, to the point that right now certain institutions have got insured books of between 20 or 30 billion dollars, which is a significant amount. And the unfunded risk distribution through insurance is actually, through IACPM statistics, the #1 form of risk transfer for financial institutions, even above funded syndication. So it is a very healthy market, and a market that is open for business. They love infrastructure. Now, public agencies have arrived a little bit late in the space, and my job, I lead globally the public agency book, so I look after our MDBs, DFIs, and export credit agencies. Particularly MDBs and DFIs came late to the party, to an extent because they didn't feel the need to transfer to private markets. But a combination of increased demand of MDBs balance sheets and the 2015 conference for development in Addis Ababa, which indicated insurance as one of the tools to stretch the balance sheets. And at the same time, the growth in the appetite of insurers has created this kind of combination, this perfect storm, where now the insurance market is really chasing the public agency business, particularly in certain areas where it's quite difficult to mobilize funded private capital. You know, when we're talking about 18 years, 20 years, 22 years project finance transaction, yeah, capital markets can do that, and obviously Nicholas will be able to talk to this, but commercial banks are simply not able to follow. Their costs are too high from a cost of funding perspective, particularly in emerging markets, whereas the insurers, because of the way they are regulated, they can reach those tenors, and they can provide this unfunded risk transfer to MDB DFIs. So this has continued to grow. Investors, institutional investors, have come a little bit late to the party. They are the latest entities which have started to look into insurance. There are some that can lend directly, and they use insurance to distribute part of the risks. But again, they use insurance to mitigate some of the constraints from a regulatory or even risk appetite that they have. Pension funds are not known to be investing into single B-rated assets in emerging markets, so insurance can be a way for them to actually mitigate some of that. We have done structure whereby we have transfer assets from MDB's balance sheets into SPVs, so off-balance sheet transfer. We wrap that with an insurance policy, and as a result, institutional investors can buy those assets, creating essentially a new asset class, a fixed income instrument that trades at a premium to an equivalent rated liquid instrument. So, you know, insurance is becoming more and more critical to facilitate long-term financing, alleviate some of the capital constraints, allows MDBs to stretch further their ability to reach where they need to do. And the appetite of insurers is really there. They love the expertise of MDBs and DFIs. They love the halo effect that working with a public institution brings. They love the diversification. They access assets that they wouldn't otherwise see with commercial banks. They love the sustainability angle. A lot of those institutions are pushing the sustainability agenda, and they can evidence that, of course, supporting these types of transactions helps them meet their targets. And of course, the preferred creditor status for organizations like AIIB. So this is a growing area, and there's more and more capital flowing into this deep pool every year. Last but not least, also the equity portion is very important. Obviously, we've got a representative here. Investors use insurance, and actually it's been the very first instrument that has been set up as a response to the inability of MIGA to provide coverage in sub-Saharan Africa. So the market reacted, as you do, you know, Lloyd's of London, very creative markets, PRI offers investors a way to protect some of their investments, On particularly two elements, I would say they're the one that come time and time again. One is the FX element, so foreign exchange, and PRI insurance can protect against that. Plus, of course, when we're talking about limited recourse financing in emerging markets, there are some long-term offtake agreements which underpin the financing, and those ones really can be covered as well. And the private market is, to an extent, a competitor to MIGA or a competitor to DFC. There are pros and cons to using the two institutions, but I would say they're super healthy. And there is also an argument, and we've had this agreement with Standard & Poor's. They reviewed our policy, and they determined that according to their model, the IHS S&P model, the insurance policy will reduce the country risk rating downside of an investment as a result of boosting the valuation of the asset. So insurance is not seen as a cost anymore, but almost as an investment.
Thank you, Fabrizio. It's illuminating to hear the insurance sector has evolved into such a sophisticated stage. And I'm sure there will be lots of conversation we need to do off the line. But now I turn to Nick. Nick was a project finance person before he did the heavy lifting of securitization. So Bayfront has been at the forefront of the downstream side of the infrastructure investment, bridging the private transaction and the public market while asset-backed securitization. What are the key challenges in setting up a warehouse of infrastructure loans? And how can this model help connect projects with a long-term institutional capital, if you can share with us?
Sure, thanks. Thanks, Greg. Hi, good morning, everyone. Thanks for having me here. It's a privilege to be here. For the benefit of those that are not familiar with Bayfront Clifford Capital, we are part of the Clifford Capital Group, which has Temasek as the anchor shareholder. We're one of the portfolio companies of Temasek in Singapore. We also benefit from the support of the Singapore government with 2 sovereign guarantees that are accorded to us, which supports our direct lending business as well as our warehousing and securitization business. We are a platform that focuses solely on infrastructure credit. We are able to originate, distribute, and also manage across the spectrum. And infrastructure asset-backed securities is obviously our flagship product that we have developed back in 2018. There was a pilot transaction. We're now the global leader, one of the global leaders in infrastructure asset-backed securities and PFCLO issuances with cumulative volumes of about $3 billion of issuances to date. So on your question in relation to how do we connect the different parties and different stakeholders within the entire infrastructure ecosystem, we feel that our business model is one that is beneficial. I think it's a win-win solution for all the relevant stakeholders within this whole infrastructure ecosystem across banks, investors, and also project developers and sponsors. Firstly, on investors, the securitization product allows investors to gain an immediate exposure to a diversified portfolio of infrastructure credit assets, and they're able to then leverage on us as the manager to originate, to credit underwrite, and also handle the ongoing portfolio management work. As you can imagine, for most of you in the room that are familiar with infrastructure projects, it tends to be quite bespoke given the fact that every infrastructure project is different, and to put together a diversified portfolio, it involves looking at projects across different countries, different regions, different subsectors. So it does take quite a bit of resources to build up a diversified portfolio. So the security format allows investors to gain an immediate exposure to one and leveraging on our origination and portfolio management resources and capabilities. Utilizing securitization also has the benefit of offering investors a listed and rated security that's freely tradable. The securities are cleared through Euroclear and Clearstream, so any global institutional investor will be able to participate in the asset class. We're investors are able to transact in a bite-sized manner. Most of the infrastructure financing project in the loan market tends to be fairly large scale. And if you are looking to transfer in the syndicated loan market, it tends to be fairly large, chunky ticket sizes. Through the ABS security format, it allows investors to trade freely in bite-sized manner, thus allowing investors to benefit from secondary market liquidity as well. So that's on the investor side. On the banks side of things, obviously banks are able to recycle their capital, especially in relation to the long-dated infrastructure loan facilities, which are not necessarily suited for bank balance sheets. So through our program, it allows banks to recycle capital into new projects, which in turn then help project developers to obtain more liquidity from the banking market. So in a way, we are a conduit for project sponsors to be able to gain or mobilize liquidity from the institutional market, given the fact that we are standing in between interacting with the project sponsors when it comes to portfolio management activities such as dealing with waivers and amendments and monitoring the projects. Developers do not have, or sponsors do not have to be dealing with multiple investors. They just have to be interacting with us as a single manager, and we would be representing our investors. Investors, on the other hand, are able to pick and choose where they want to play in the capital structure, and hence aligning to their own risk profile as well. So it's a good way to connect the institutional capital markets with project developers through us as a conduit and through the product as a conduit, given that it's just a lot more suited for the nuances of the infrastructure market. On the challenger side of things, as we kind of talked about earlier, infrastructure itself as an asset class is fairly illiquid, is chunky, is bespoke. We have to analyze every single transaction. As a firm, we do focus very much on the credit underwriting work. We have to balance across the key considerations of credit, ESG, and returns to be able to build a suitable and diversified portfolio for securitization. So that takes quite a bit of effort to amass a portfolio of assets, which is why that's where the warehouse that we have is fairly helpful. It allows us to interact with banks and also sponsors on a lifetime basis. We do not necessarily have to wait for us to, sponsors or banks do not have to wait for us to look to execute a securitization transaction in order for us to be able to bring in assets onto our platform. So that's helpful, I think, in order for us to crowd in assets into our pool.
Thank you, Nick. That's actually very important sharing. I thought one thing probably people most misperception is once it's a securitized, the lenders are not involved, but actually the original lenders still hold some of the loan, and they and these securitization issuance vehicle play hand in hand to manage the risk. Otherwise, it's impossible for institution, for the retail type of investor to manage that type of risk. Now, if we move to the second, perhaps the third topic at the same time, given the time constraint, the capital has been raised. The capital needs to be deployed. And also, when you raise capital, the investor universe keep evolve. So along those lines, maybe I ask Princess Raziz the question. The PIF has been playing a major force in channeling this long-term capital into the strategic sectors within Saudi Arabia and globally. So from your vantage point, what are the most effective strategies for aligning the sovereign investment priorities with this private capital mobilization?
Thank you so much for the question. I think it's a very important and timely, actually, topic. From our side and from the PIF side, we view the sovereign, I would say, capital deployment as more of an enabler and the catalytic, basically, for private sector contribution. And I believe that there is a complementary, I would say, value proposition between what we do in terms of unlocking new sectors of the economy and paving the way, obviously, for the private sector to come in and find lucrative, I would say, investment opportunities. If you look at the PIF ecosystem, we're investing into new sectors of the economy, sectors that were never and were not actually visible in the Saudi market. We're talking about renewable energy, tourism, electric vehicles, for example. So if I take electric vehicles as one example, what the PIF is doing, PIF is coming in as a first mover, creating the infrastructure in the electric vehicle sector to enable the private sector to come and find opportunities. What we did first is we've invested internationally into a well-known electric vehicle company from a strategic lens and strategic point of view, which helped us actually to bring back know-how and knowledge to the kingdom. On the sideline of that, we've created our own electric vehicle company, which is called SEER. We've also invested heavily into the infrastructure of EV in terms of creating the charging stations as well for electric vehicles. And we've also identified what are the key ecosystem, I would say, opportunities that are viable and available for the private sector. And we've seen a lot of private sector, tier one, I would say, suppliers coming in, setting up shop in the kingdom, basically, to support that ecosystem as a whole. So what we've done, we've invested into a sector that was viewed as a risky sector or a new sector that the investors don't really know about. We've created, I would say, a bespoke opportunity and a success story for that sector, enabled the tier one, I would say, suppliers and investors to come in and invest into those sectors. Second, what we do is we usually create those strategic, I would say, structures that also enable private sector to understand what opportunities are available for them. So when we look at a transaction or a project to be financed, we have a 360 view. So we see what is better, I would say, supported through pure equity investments from PIF, for example. What part of it should be supported by concessional, I would say, financing from developmental banks or DFIs? Which part of it could be enhanced through, credit insurance, basically, or credit enhancement solutions? And which part of it could be ring-fenced, basically, for pure private sector contribution? What we're doing as well is we've created something called the Private Sector Hub, where we've identified key opportunities around the ecosystems where we've created giant or mega, I would say, companies for the private sector to come in and invest in those ecosystem opportunities. Some of which we actually provide, for example, support from an intellectual capital as well, and a lot of opportunities for them to come and invest in it. Another program that we've created called Musahama. We have a mandate to obviously develop 60% of the local content sector in Saudi. So through that program, we're also enabling those suppliers basically to come and set up shop in the kingdom and support in terms of providing opportunities to them. Third, we're creating those networks as well. We have a private sector forum that is now an annual, actually, forum, where we also engage heavily with the private sector to understand what are the bottlenecks. How can we translate and support in actually communicating those bottlenecks to policymakers in the kingdom to help also pave the way for them to come and participate. So our main goal is actually to crowd in private sector contribution. And we do this through also recycling some of the capital that we invest through pure equity. Once we prove a case, it becomes successful and profitable, then we recycle that either through IPOing those companies and providing other, I would say, private market opportunities for them as well.
There's a marvelous sharing on the ecosystem we're trying to build and the communication with the investor so that they can understand what could be the priorities for a mutually beneficial relation. If I may turn to Munir, Rakiza is actually heavily regional focused funds on infrastructure sector. But I know before your role in Rakiza, you were also leading the local initiative to upskill the local players in Oman to build the economy. So from all your experience before and at Rakiza, what makes a project truly suitable for private investment, whether in terms of a scale, structure, or risk profile? So how do you assess that early on when you plan for your investment, if you can share with us?
Thank you for sharing part of my experience, Gregory. I mean, as you said, I was lucky also to have the chance to work for 2 years in Vietnam. So I've also seen how emerging markets, which actually quite different to our markets, grow, and what is the need for private sector attraction in certain sectors. Going back to your question about Oman, I think what was critical for us to see a successful private placement into these projects is to make sure, as you stated, that these projects are bankable. These projects are structured in a way that actually they have the right commercial targets, they have the right returns, and they are in a way also have the right risk-adjusted return. Ultimately, it's not easy. It's not straightforward. There is certain maturity that you should have within the system to understand how you provide the right concession, how you provide the right offtake agreement, how you make sure that whatever structure you come up with, ultimately it's easy for investors to digest and be able to invest. I'll give you a couple of examples. I think that will allow us to see where we have started and what we have achieved, especially when it comes to Oman. We started our first IPP in Oman in 1994, and I think we were the pioneer in the region at that time by basically trying to attract private sector investors into that sector itself. And at that time, to make sure that it is bankable, it is basically something that investors would be able to do, we had to make sure we follow a certain model. And we used the UK model, which actually helped us a lot in making sure that we were not starting something new. We're actually using what others had done and made it successful. And it went very well with us. Today, 100% of the generation sector and the power, it's 100% financed by private sector. It's fully basically owned by private companies internationally, companies from China, companies from Singapore, companies from the region also, and from the West. And the same thing we did when it comes to the transmission sector. We privatized that sector lately, and the idea was also to make sure that it has the right structure, I would say, requirement to make it attractive. So the regulator worked closely to see what's the best model for the transmission sector to be privatized. And they basically made sure that this structure was also accepted by banks to secure the right long-term financing for such assets. And they were successful in doing that. So there is a learning curve that we went through to make sure that actually it is successful. One thing to say that actually there is certain cost to this also. At a certain time, you have to make sure you leave some money on the table for investors to make money. And once investors make money, they come back. And they come back, and definitely that is something that will allow you to also attract more and more money when it comes to basically, especially when you look at equity investors. And then definitely by time, it becomes more competitive. And when it becomes more competitive, you have the right cost later on as a procurer or as a government, ultimately. Second example I would think is to share our basically story with our investment in the central market in Oman. It's quite a unique investment. I don't think any other infrastructure fund in the world will look at it how we did look at that investment. So we understand exactly what kind of characteristics you need to see within the project for an investor to come in and invest. And that's how unique we are as a regional investor. We understood the issues within the market, but ultimately what we did is basically work closely with the government agencies, with the stakeholders, structuring the project to be infra. friendly. Instead of looking at it as a real estate project. We signed a concession agreement with the municipality for 25 years, monopoly kind of agreement that allowed us to be exclusive provider of such a service for 25 years. And that made our demand risk minimized as an investor and helped us to raise the right financing for the project and ultimately made us also very good returns. And what we did is actually we made sure actually that we as an investor we delivered the project to also show the public sector how these projects can be delivered. We delivered the project on time, on cost, and also managed to work with all the stakeholders to secure them all on board in this project. So there are sample examples. I would say that some are not popular, but it's specialized and it's to the nature of the business that we do. But ultimately, it's not a straightforward story. Countries will need to build their capacity, will need to build their legal frameworks, will need to make sure that the local banks also understand how these projects are financed, and certainly work and get to know the experience of other countries. I was really astonished by the story of Brazil and what Her Excellency just shared with us and how they're trying to make sure that they have the right bankable projects for private investors to come in. So that's in brief, actually.
That's a great sharing, especially how the local work with the investor come from outside of the world. Now, if I may turn to our Ambassador Tatiana, congratulations for Brazil to be the chair of COP30. There must be lots of a topic Brazil want to unleash through this leadership. There is an aim to build the political momentum and alignment around the financing priorities of the Baku to Belém roadmap. Could you share how Brazil envisioned this initiative, complementing existing climate finance efforts, and what role you see for multilateral development bank and institutional investor in scaling up this impact? Do you envisage any changes to the composition of the investor base when Brazil is leading this journey?
Well, thank you, Gregory. This has been, thank you for this very timely question. I think the conversation that we are having here today has, everything to do with what we are doing for COP30 on the finance side, at least on this, and I have the opportunity to share a little of this circle of finance ministers for COP30 that we are leading. Actually, I have just come from the London Climate Action Week, where I spent 2 full days discussing on securitization, insurance, and with all the, private sector actors on how to scale finance for developing countries, just for the benefit of the audience to be on what we are doing, where it comes from. So on COP29 in Azerbaijan, there was this decision to create a roadmap, the Baku to Belém roadmap for 1.3 trillion. It means 1.3 trillion of external resources to developing countries, right? So, and this is more or less, the numbers add to, maybe twice that would be on resource mobilization in developing countries. So that usually we say in developing countries, ex-China, the challenges of, climate investments or investments to have the climate and energy transition and to achieve our Paris goals would be at the order of, 3.4 trillion per year and by, 2030. And so about 1/3 of that is external, considered like external funding, including not only concessional resources and non-concessional, but also resources from MDBs and resources, the mobilization that would come from MDBs. And both public and private resources. So we think that about half of this 1.3 would come from private sources. and half from public sources. So this is more like the equation that we have in mind. Right now, I mean, for climate finance, out of this 1.3, actually only 40 billion comes from private finance for EMDs. So we have to multiply it by, almost 20 times by 2035, which is our target. So I think one part of the, there is, so what happened is the president of COP30 has invited the Minister of Finance of Brazil to lead this circle of finance ministers for COP30. And why? Because a lot of the levers that we have to pull for mobilizing finance would be very close, I mean, to the day-to-day and to the tasks and competence of the finance ministries, and also to central banks in many ways. But and I will tell you the priorities we are working on. It will be very clear why. So we are working on the 5 priorities. The first one is reforming the MDBs. I mean, continue to reform. This is a process that has been going on. Last year we have an opportunity in G20 to lead the approval by the G20 partners of a roadmap for MDBs. The idea there is to, and it incorporates the capital adequacy framework that already has been mentioned, many of the challenges to have MDBs have more risk appetite. Right? Mobilize more money, using their source of capital in a wiser way. Maybe capital constraint is not a problem for AIIB, but it could be a problem for other banks. And one day we hope it will also be, because AIIB will be so big, so that you need, but you need always to do it and to use it more efficiently. So I think, and MDBs are a crucial actor, because as was also, I think, shared by our fellow panelists, there should usually in projects today, in many projects, there is a role for everyone. And MDBs really would actually, not only because they lend long-term, concession or not so concessional money, but it's a long-term perspective. They bring knowledge. They have their reputation to also bring other partners, so it's very important. The second priority is expanding concessional funds and also vertical climate funds. We think they could bring, more concessional catalytic money, including to help MDBs and to help private sector mobilization. The third priority is strengthening domestic institutions, including country platforms. So, and this includes having more, strengthening the capacity of countries to have more fiscal space, to have better public investment, deepen their capital markets, their tax and fiscal policies, so on and so forth. The fourth is private capital mobilization through new instruments. For example, we're addressing a lot the hurdles to increase the use of guarantees, of first loss guarantees, of securitization mechanisms, which, as we heard, they already used. But I think the challenge now is to really scale it up. How can we make it really, because the flows that go to EMDs now, it's very short of what we need. So less than 15% of climate finance, no matter what you do, go to EMDs. We need to scale this many times, not only because actually the target, it comes the other way around, because we have an immense growth and investment opportunity. And 60% of the investments that we need for the climate transition will be in EMDs, either through energy transition, through electrification, and to many of the challenges. And the fifth priority, last but not least, it includes also important issues that could accelerate that. So all the priorities, they are in a way intertwined and they help each other. So carbon markets, to continue to work on carbon markets, voluntary and compliance carbon markets, taxonomies, to help push the interoperability of taxonomies, also to help investors, and regulatory and supervision issues. That's where the central banks would come, of course, and regulators. We are dealing a lot with, including with, what does Basel III and what improvements could be made in, for example, Basel III, and some, for insurers, you don't have, the same regulatory, let's say, harmonized world, but like talking to the Europeans, the Solvency II, or the regulations in different countries, like in the UK, how can we actually may have a level playing field so that when you invest in some of the projects in EMDs, you were not, let's say, the unintended consequences that the regulation, we think the regulation is very important. It's just to address those consequences that are unintended, and that means that you are penalized for investing. The banks are penalized, or they have higher capital requirements to invest in MDs. So this is a bit of what we are working on with the, 33 countries and over, with international organizations and with advisory groups of experts of the private sector and also civil society. So this is really, truly, it's not a negotiating effort. This is for you climate negotiators, but is a mobilization and engagement effort that will bring, this a greater involvement of the Ministry of Finance, which already started in a few years. It was, I think, also, it grew a lot last year with the G20. But now we have another chance to give, also some, help for the success of COP30 and the, important multilateral event.
Thank you, Ambassador. In fact, these are such positive news, I think, for many private sector players, including our securitization friend. Because you were talking about trillion, but off the line, he shared with me how big the infrastructure ABS market is globally, and then how big is the Asia part. So I heard some much smaller numbers, so I would probably poke Nick. What are the key challenges in scaling infrastructure securitization in emerging markets? And how can multinationals and the policy framework help address them? Well, that's a good platform for you to voice it.
Yeah, so I would kind of highlight 3 points, which is number 1, investor preferences, number 2, ratings, and number 3 is really currency. On investor preferences, especially on the credit side, unsurprisingly, the vast majority of global credit investors prefer to deploy into developed markets. And hence, utilizing the securitization technology, I think, helps blend developed market and emerging market exposure, but naturally, we still need to maintain a certain level of mix. Issuing a transaction that is solely focused on emerging markets is probably a little bit more challenging compared to having a portfolio that's diversified across 15, 16 different countries, combination of developed and emerging markets. So investor preference is one, which can be addressed through blending, through us taking the first loss as the manager. It helps credit enhance the notes that we issue into investment grade. That kind of leads into the point of ratings. In a lot of the emerging market countries, because of the country ceiling, even if the projects are backed by, say, the sovereign or state-owned off-takers, the project's rating would tend to be capped at the sovereign rating. So the ability to include a large proportion of sub-investment grade type of transactions into the portfolio has its limitation. So again, the blending approach is required in order for us to get to the right profile of portfolios that we can securitize and bring to the global markets. Finally, currency is another consideration for us. We are a hard currency player because our balance sheets are US dollar denominated. We're able to fund in hard currencies because we're able to then swap them into US dollars. When we bring the transactions into the capital markets through securitization, we have to get the notes listed and rated. The rating agencies requires any mismatch in currencies to be swapped into maturity as well. So the ability to incorporate non-G7 currencies into the portfolio has its limitations too. So the ability to source for long-dated swaps for local currencies is another area of limitation. So I would say those are the three major areas of considerations when it comes to scaling up our exposure in the more emerging markets. Certainly with policy frameworks that are helpful in relation to risk allocation, it helps. We do get this question a lot when we engage with our investor base as part of the marketing of our transactions. How do you get comfortable with exposure in certain emerging markets and so on and so forth? We tend to focus on the credit aspect, right? Highlighting how we get comfortable with the policy framework of that country, how is the risk allocation handled in the offtake contract between the offtaker, the lenders, and the equity owners. I think those are quite important. Having a very robust policy framework for that specific project, which adequately allocates risk amongst the different stakeholders within the project is quite important. Certainly, MDBs can also be very helpful, especially in relation to scaling up the provision of guaranteed products or political risk insurance. That can certainly help us address issues, for example, in relation to ratings and also any gaps in relation to policy frameworks.
That's great. You mentioned all these wish lists, including guarantees, etc. So on that note, I would ask Fabrizio, you ever heard this conversation among all the panel, the wish from the government side and the wish from the securitization side. So what would you share with us, your observation after having heard all these conversations, how to better leverage the insurance market to scale up private capital flows into infrastructure?
It's a good question. The insurance market is a naturally conservative market. Insurers tend to be conservative, but once you bring them along the ride, once they get to know you, once they get to understand how you operate, then you've got a partner for life. Some of these institutions have been writing business for many, many, many years. And what we see is that particularly the public agency world is essential in pushing them to extend what is conceivable. And we are dragging them into transactions, territories, tenors, which they would have never got into if it had not been for a public agency being there. And this is true mobilization, because through the engagement with the public agency, they learn skills and they learned to be comfortable with a particular territory. And the next time around, they'll be able to do it for a commercial bank, for example. So trust is very important. The transparency as well, insurance is an imperfect information world, and as a result, the more transparent you are about the risks you're facing, the better the insurers will be comfortable with a deal. And the collaboration, I think, obviously, we've just discussed. I would be remiss for institution not to say that use of a broker is a good one, because I'll be out of a business otherwise. But I would say that helps a lot, taking a lot of the workload out. It's still a relatively manuscript world, and it's still it's not automatized, it's not a commoditized industry. A lot of these transactions are very complex and they tend to be done one-to-one. So you need to have somebody who can coalesce the market and support the trades. Although we're moving towards more of a systematic approach, insurers are looking at facilities. The first ones that worked well were in trade finance, which are very large. There's two fellow NDB with a large trade facilitation program, and they use insurance as a way to leverage private capital. That securitization is the other big point. Synthetic securitization with the use of insurance has been used by AIIB, Inter-American Development Bank, Invest, as part of their recent program. So you can be programmatic, but you just have to bring the insurers with you for the ride, because that, I think, is quite crucial. But the goodwill is there, I would say.
Thank you. We hear loud and clear, the goodwill. But as the moderator, I have the duty to manage the time. I'm conscious we actually, with such rich panel discussion, we have almost fully used up the time. Princess S. Raziz actually have a prior commitment, so she must go for that. But let's give her a big hand. Thanks for her sharing. After that, I do want to open the floor to 1 or 2 questions. Yeah. Now I would allow for a small time overrun, because I feel from the occupancy rate of this room, there's quite a lot of interest on the panel's discussion. So I would open floor to see, after this discussion, if you have any questions for our distinguished panel. Microphone. Please introduce yourself. Okay, first. Yeah.
My name is Shen Wang. I'm the CEO of a SAF, Sustainable Aviation Company, Sustainable Aviation Fuel Company. My question addressed to Mr. Rosito. So when President Lula visited Beijing in May, and actually our company we entered into a MOU with one of the biggest biofuel and also the ethanol producer, AIIB, from Brazil. And my question is on the biofuel and also sustainable aviation fuel on this field. And what do you think about the private capital's role and in combination with the, for example, sovereign wealth fund in really making the market for the sustainable aviation fuel and also for usually in general we call the green fuels, because this is the very good way for China and Brazil to work together. Thank you.
Thank you very much, and thank you for the question. Actually, we are, very much keen to do exactly that, to expand this avenue. The Ministry of Finance in Brazil has been actually a very active actor in terms of the new legislation on biofuels and the fuel of the future in Brazil to incentivize the use of sustainable. One of the sustainable aviation fuel, also fuels for maritime transportation. There is a huge potential there, especially coming from ethanol. And I mentioned before one instrument that we are using for that. One is this Brazil climate investment in ecological transformation platform. It's not something vague. It's something that is already there working at the the secretariat at BNDES. We do have in the platform a few projects from this field, and the idea of the platform is really be the conduit for doing exactly what you just mentioned. So for allowing for some blended finance in this. There are, of course, risks specific to the sector. Offtake is of the essence, right? Even if it can be covered by some, insurers, I think this is one of the basic issues. Also, all other issues related to, even the productivity of, the specifics of the means of commodity from which you're going to get, right, the fuel. And then bringing together these actors. So another area that we have been so we incentivize a lot that. Since you mentioned President Lula in Brazil and China, I am actually also tomorrow we are having a meeting of the strategic committee of the Brazil-China Fund for sustainable, for productive capacity and sustainable development. And we have, the partners, the operational partners, BNDES and CLI Fund, looking at projects, including in this sector. So this would be another, immediate avenue that we can use for this. So I really thank you for the question.
Thank you. The lady first, and then the gentleman.
Hello, I'm Katie from the UK Treasury, and I also have a question for Ambassador Rosito. I know you've been in London for London Climate Action Week, and there was talk about regulatory barriers to investment in EMDs. I was wondering if you could talk in a bit more detail about what you see as the key barriers in the regulatory space.
Well, thank you for the question. I'll be cautious here because I'm not a regulator, right? So, but we are, this is one question that we have actually for this specific, let's say, priority in our, in the finance minister's work and the document that we are aiming to produce and to be, shared and presented to the group of finance ministers in October at the IMF World Bank annual meetings. But we made a point of, we are actually, this is the 5 priorities we are discussing with the members, but we make a point of putting it there. Even if it's not only, essentially finance ministers, it's more of regulators and central banks, because it is, such an important issue that is usually raised by banks, by insurers, so there, in terms of the prudential supervision regulation, I think there is a lot of work that has been, done and material that has been produced, and we have, come in terms of trying to incorporate, climate risks, through the FSB, the BIS. There is more work to be done. Right now, actually, climate risk, although it's a huge risk and it also has a lot of impacts, long-term consequence for infrastructure, for example, for investments on resilient infrastructure. It is really just seen as usually through the lens of the ordinary risks like market, credit risk, liquidity risk, right? So we are still, I could say, as a global community and the global financial community, struggling to have to improve the way that we measure this, right? And we even know that some of these risks are, as we say, uninsurable. But, I think we want to move to a road where the most important ones, we could understand this better. Of course, when we talk about data, if we are talking about the future, then it's not so easy as when we talk about data in the past, that what would probably be the basis for the models of our insurers. So this is quite a very important risk. Now, so one issue that usually is raised is the stringent capital requirements for investments in projects that are perceived to be of higher risk, for example, in developing countries. That a lot has to do with methodologies from credit rating agencies, but not only. Some of them has to do with regulations too. This has to be taken with, in a cautious way, because, the regulations that we have, usually they have been, a necessary development, in the aftermath of the global financial crisis, but they could have some unintended consequences that mean they don't have a level playing field for all countries. And since we are in this, mission to increase investments, in EMDs, and I think it's very important, the caveat that I mentioned before, is not out of some, let's say, out of the blue decision, but is that because there it's where lies the most challenges for the net zero, and also the greatest opportunities, right? So I think it's in the interest of all the countries to try to unlock this. Like we have also, if we think about assets, we have 40 trillion of assets in the insurance industry, right? How can we also package more instruments, that would be tailored to some of those investments. So we are finding out that there is a lot to do. So this is for, and then there are specific issues of regulations related to a lot of technical details on guarantees, but basically they would translate into making sure that we don't have unintended consequences of the regulations, or that we can mitigate that with instruments, and that we have the financial, the banking system able to increase these investments without making, such a risk of course, for financial stability. I think the same happens to MDBs, right? We want MDBs to take more risk, but we want them to maintain their preferred creditor status, right? We want to actually lend to us at, lower rates always. And the second two aspects are I mentioned taxonomy and carbon markets, whereby these are clear areas that are tremendous signals, very important signals to accelerate the transition. So we'll be working with actors to have in this roadmap commitment, so that we can continue to disseminate the use of these instruments. Thanks.
It's a marvelous answer you give it. This is the last question. Yes.
I'm Raja Parthasarathi from Morgan Stanley. Thank you very much, Greg, for deftly guiding this discussion, especially towards areas of risk mitigation we've heard around, whether it's policy, regulatory, the FX, insurance, securitization, on the operator side. Now, we all know that there is capital available for investing. There are mechanisms available today, broadly accepted around mitigating risk. And yet the flow of capital, particularly to developing markets, seems to be a trickle. And I don't know who this question is best directed towards, but I thought it might be helpful to just hear a few thoughts around what one or two things need to happen for that trickle to increase to more of a flow on a consistent basis.
Thank you. I would assign this question. It's actually very difficult to assign how to. I give some background before I assign. I would ask Munir and Nick to probably give the comments from both sides. When I travel around, meet counterparties, people keep talking to me. We want you to invest in emerging market. But I always ask them, well, what's your definition of an emerging market? Yeah, because without define it, it's very difficult to see how you make the flow. Is it the frontier market, or is it the already relatively developed emerging market? So I pass maybe to Munir and Nick to share their respective views.
No, thank you very much. I think for global allocators, it's always difficult to understand the risks associated with these markets. If you're not close to the markets, you'll never understand them. And from my understanding always that what is special or what is required for you to make it a successful allocation to this is that you need to have the right local partner to help you understand the local issues, to help you to navigate through the local issues. Unfortunately, developed markets always have the majority of allocations as usual because of definitely the pipeline of projects, the understanding of the regulatory framework, the legal framework is clear, and for any financial investor, let's talk about pension funds, Canadian pension fund, or let's assume an insurance company working in the US, they know less about emerging markets because there's not markets that they serve, there's not markets that they understand. So it's difficult for them to tell them, come and finance a project in a region where basically if there's a currency risk, if there is certainly, I would say, regulatory risk, political risk. So probably packaging these projects, helping in understanding these projects, and ability to basically also demonstrate to them track record of some of these projects, especially through operators like us who are locally and we understand what's happening there, will allow them to basically see a better, hopefully, allocation to be given for emerging markets. I do that always, and I do speak to my other peers in the market, fund managers, that we need to educate these global allocators more and more, and wherever we have the chance to go and speak to them. Especially when you talk about investing in infrastructure. Infrastructure investment is almost the same in any country, you know. Especially if you have an offtake agreement with a credit-rated country, okay, and it is in a USD currency, what kind of risk you're taking there is almost the same as if it's in developed market. Okay, there is a certain country risk premium that you want to charge for that investment itself, but that's something definitely you can always price it, you know. So we've seen, speaking about the region, in the last 5 years, we've seen more allocation coming to the GCC region because of the projects that we've announced, projects that we've given to some of the global basically allocators. And we've been educating, we've been attending events and talking to people. Infrastructure is the easiest asset class to allocate money for. It has similar characteristics. And definitely you can allocate more and more money there. I don't know if I was able to cover the question.
Yeah, I mean, firstly, I would just somewhat echo when you're saying there is, in a way, a perception issue, which translates into the amount of premium that's required for investors. And naturally, the vast majority of capital is coming from the developed markets. And hence, the investors are constantly deciding, okay, am I going to be allocating into the US, Europe, or am I going to be allocating into some other country? And because there is a perception of a higher risk involved in investing in the emerging markets, or just because of the lack of familiarity, there's always that requirement for premium, which means that if there is a misalignment in relation to what a developer is able to accept, or what the off-taker or financiers are going to be able to accept in that specific market, then capital and project can't match. The other point I would add is, we talked about risk mitigation tools. Yes, they are available. However, I would say that the view of what's acceptable for different risk mitigation tools are different across different stakeholders as well. For example, if we think about insurance, the rating agencies do not recognize any of that. If you have exposure in a certain country and you completely, let's say, insured it with an insurance policy in the private sector, none of the rating agencies will give us any, or give the benefit of the insurance cover any uplift in terms of credit rating. If it's a guarantee product provided by one of the multilaterals, yes, you do get that benefit, right, or an export credit agency. So it's not consistently applied. I mean, yes, even though I would say having an insurance policy overlaying, a certain project does help us in relation to risk mitigation. However, if the rating agencies or investors or other stakeholders are not giving any benefit to that, then it's never going to be driving more projects, because even though the risk is technically mitigated, it's not being recognized at all.
Well, let me add something, because I think it really depends. The vast majority of what we see in emerging, and the insurance market that I operate in is primarily an emerging and frontier market. Okay, that's where it was born. It expanded in developed markets in recent years in a big way. Why? Because there's a huge investment in infrastructure in Europe and North America and Asia. Okay, so a lot of the banks decided there's a better risk returns to invest in North America or in Europe, so they stop investing in emerging markets. And who steps in? Multilateral development banks, DFIs, to provide that long-term financing. And that's where the insurance market comes in handy, because they actually like those countries, they like those risks, and they can offer those unfunded guarantee. But I see in emerging market primarily bank business and MDB DFI business. The capital markets, which is where the vast majority of the money sits, and my organization, part of my world, is Mercer. Mercer is one of the largest wealth advisors in the world, and in an ideal world, I would be like, okay, can't we use some of that capital to support the business of our clients in the emerging market. I think a big problem is regulation. I mean, under Solvency II, you simply cannot invest into an below investment grade asset. They're going to kill you. You're not going to put money into that from an insurance company. So if you're an insurance company on the asset side of the balance sheet, you cannot invest below investment grades. It's hugely punishing. And that's the reason why insured credit strategies are coming to the fore, which I alluded before. We're wrapping assets with 100% credit insurance by a single A or double A rated paper. That what allows the insurance company, asset side, to invest and provide liquidity on that EM assets for the long term. They invest in what now see is a double A rated paper. They get worse returns, of course, because they're going to have to pay for premium, et cetera, but they get a pickup to an equivalent rated liquid instruments. Now, is this done at scale? No, it is definitely not done at scale, but it's becoming more and more prevalent. Rating agencies do rate these instruments, and the insurance companies do get the benefits. Admittedly, not the big three are struggling with that, but there are some smaller rating agencies, Scope, ARC, that provide the credit ratings, and some of the asset managers we work with, they are happy with that. Others, they've got the ability to rate the asset themselves internally. We are working with a series of large institutional investors who are looking into this asset class to try to scale up the lending. So it is difficult, I agree. There's not a huge amount of liquidity going to EMs, and I think the way that the world has gone in the last 5 years has sucked away some of that commercial banking liquidity that we used to see more in EMs. Why? Because there's better return elsewhere. So I think a lot rests on the shoulders of MDBs and DFIs and ECA to open the marketplace. We are going to play a part, the insurance market would play the part to create these credit enhancement solutions to allow institutional investors to come in. And the other aspects, I think, institutional investors themselves, they slowly going to get accustomed to this. And, Bayfront's growing at scale, perhaps the insured credit strategy growing at scale. I think that is where we need to go. But it's really the institutional capital that needs to move. I don't think we're going to move the needle only with the commercial lending. I don't think it's going to get there.
Great. I saw the sign. We have to evacuate. But I give you a quick wrap up. When I was asked to moderate this session, I thought, well, this is a very challenging thing. Innovation is very difficult, but I sincerely thank all the panel and all of you for the discussion today. I think it gives us lots of a takeaway. I quote our founding president, President Jin. He always asks the management team, he said, can you really think out of a box if you don't stand out of a box? I think we all need to stand out of a box, as the ambassador alluded and as other distinguished panel alluded. There has to be some systematic discussion across regulation so that people don't suffer this unexpected consequence if we were to bridge the gap of infrastructure financing. So I encourage you to look at this as a half glass full rather than half glass empty when leaving this room. Thank all of you. Let's give the panel a big hand.